All right, folks. Hope everyone's doing well. Hope we had a good end of the week. Sorry for my appearance. I look a little scruffy. I understand that. Just wanted to catch up with you guys really quick, give a quick end of the week, and really just talk to you guys quickly about what I purchased this week, and maybe we could talk a little bit more on it in a different video. But yeah, just wanted to hop on. Felt the energy to kind of show my face a little bit and hear and talk to you guys. And I think we should just jump right into it. So appreciate that it's going to be a little bit interesting as I jump over to my new screen here. But we ended the week, or we started the week rather, on the 11th, opening up about 290 on the SPY. So about 2,900 on the S&P 500. I'm using this kind of as a proxy. And we get into the week about 28.62, so just over 28.50 there. Gets us close to about a 1.3% decline for the week. So if you're kind of looking at it, we started off okay, thinking that we might potentially go up on Monday, and then it's kind of withered off for the rest of the evening into going into Tuesday, and then it kind of hung out there on Wednesday, going up for a little bit of a rally towards the end of the week, but not enough of a rally to close us up for the week. So nothing too crazy there. Not like we had any big 5% huge drops or anything like that. We did see this big drop on Monday morning, which was cool. I know a lot of people were trying to buy in or not Monday morning, Thursday morning. I know a bunch of people that were trying to buy in. Some Realty Income Corp was a good one. JP Morgan was a good one. I personally jumped in on both of those, I believe, on Thursday. And I'm trying to think, is there any others that I kind of missed? But there was specifically going back to what I actually purchased this week. I did buy a decent amount of stuff, like I mentioned on Wednesday. So a day before that big drop that we saw, I did actually end up purchasing some Realty Income Corp. Purchased myself about 35 shares of that. So I'm pretty happy with that. That's nice because at the end of the month, it'll allow me to get another about $100 a year in dividend income. So I'm pretty excited about that. Did buy some more JP Morgan the same day on Wednesday this week, about another 35 shares as well. So able to get my financials up a little bit more. And that also gives me about another $126 every single year in dividend income. So I definitely can't complain with that at all. Did end up buying some JP Morgan again on Thursday, another 15 shares to even out the position to a nice whole 100 shares. So that obviously is a big marker for me because it's about an $8,500 position. I guess at current moment, about $8,600, $8,590 is the stock price. So that allowed me to get another $54 in annual income, which I believe will continue to grow, about 90 cents a quarter. So $3.60 every single year for every share that you own. So yeah, I mean, that's $360 now that JP Morgan will be paying me. It's not the close to $1,000 that I'm going to be getting from Wells Fargo. But at the same time, I believe that $360 is a really secure bank company. I don't think that JP Morgan's going anywhere. I believe in JP Morgan at the moment as a long-term play more than I believe in Wells Fargo at the moment. But I do believe Wells Fargo isn't going anywhere either. I just think that they do have a little bit more tarnished assets on their sheets at the moment. Both companies don't have a lot of allocation or assets specifically in oil and gas. And both of them did take a good amount of credit expected losses in the first quarter. We saw that in the earnings report. So I think those are really good companies to own at the moment if you don't have any already. Although it would be nice to kind of see what full May kind of has in store for them. But I do think that Q2 will be pretty rough for both of those organizations as they continue to take credit losses as we continue to open up the economy. And another one, my buddy Kyle from Passive Income Investor also touched on this one. Bank of Nova Scotia, I think it's a phenomenal organization. Look at the balance sheet. I'm always continuously surprised by Bank of Nova Scotia. And I think it's a good opportunity to buy here if you don't have it already. I think it's a great buy. I like Bank of Nova Scotia personally. Kyle did a really good video about all the Canadian banks because he's on the north side of the border there. And he gives his idea as to what good banks are. if you are looking for U.S. exposure, TD Bank is a good one as well. I would say TD Bank is probably the J.P. Morgan of Canada, if you were to ask me. I think that they have a phenomenal asset sheet of assets, I guess you could say, and I think that they're pretty good. They are trading at a little bit premium to book value with respect to what other Canadian banks are. So not by no means is it trading at 2 times book value or anything like that, but it is trading, I think, a little bit above book value. So if that matters to you, maybe it's not your best pick, but I still think overall TD is a phenomenal pickup. With respect to the BNS, this gets me to about 225 shares in total, which is pretty nice. So that in all will probably get me close to $500, $600 a year in dividends. This particular purchase alone of 85 shares will get me another $217 or so. Granted, there is some currency fluctuations with that, so it does change a little bit depending on the strength of CAD versus USD. But overall, it's never that big of a deal. It might swing 4 or 5 cents every single quarter, so a little bit less than 10%. So it's relatively nice to keep in the portfolio. I do like it. I do get paid out in USDs. I don't get paid in CAD because I do buy it on the New York Stock Exchange. So there's no issues with that. So yeah, can't complain with that at all. I mean, just in those 2 purchases alone, we're looking at close to $400 or so of increased income. Granted, I did sell 2 positions in order to kind of swing into this. So I did sell Kinder Morgan. Not anything wrong with Kinder Morgan. I was down 25% from recent highs in Kinder Morgan. And I said, hey, I'm down 25% in Kinder Morgan. I could buy a JP Morgan that's down close to 35%. And I'm more comfortable with that money going in there. So I took that $1,000 or so from Kinder Morgan, plopped it into JP Morgan for that initial 15 or so shares. And yeah, I can't complain with that at all. I think that that's a good trade-off. Gets me a little bit less risk and exposure in the energy sector, trading it for financials. But at the same time, I think JP Morgan is a lot less risky than, say, a Kinder Morgan, which has a lot of debt on the balance sheet. Bank of Nova Scotia, I justified paying for this and buying this by selling my Phillips 66. So I sold about 42 shares and change of Phillips 66, which was about $3,500, I think. It was trading at about $71 a share. So it was maybe closer to $2,800. So maybe I did reach into the coffers a little bit to purchase the BNS, but it was maybe a couple $100 if at most. And once again, Bank of Nova Scotia, the banks here in Canada are relatively high quality, and I'd much rather get rid of some of that exposure to energy and dip it into financials. By this point at the moment, you're probably sitting there and thinking financials is already your biggest sector at the moment. And I would agree. But aside from Wells Fargo, I did trim some of the other riskier banks that I had in the portfolio. So I did trim US Bank as well. So I said US Bank, I'm down, I think it was 25% in US Bank as well from overall position. So I said, hey, you have JP Morgan that's down 35%. Take that 25% loss in US Bank, put it back into JP Morgan, a better asset, a better stock, and a better bank and all around. And so I said, take a 25% loss, put it into something that is currently down 35% from all-time highs. And I think it's just a better stock as well. So remove some of the risk out of the portfolio, consolidating some of these positions, getting rid of 3 positions in total. So Kinder Morgan, Phillips 66, and US Bank, and putting it and consolidating and strengthening 2 high-quality banks. I would say one of the best banks in Canada and the best bank for sure in the United States. So can't complain with that. Just like I always do with my Robinhood, I add $250 or so every single quarter. No, not every quarter, every 2 weeks or so. So the beginning of the month and the middle of the month, I add $250 to my Robinhood. I do the same with M1 Finance, but that goes in on the 16th, not the 15th, just in case there's any trickery or anything like that. With the 15th coming on a weekend or anything like that. I don't want it to get pulled out of the account early. So something I always do sillily. I get paid on the 15th, and that's why I kind of just want to have it the day after. You never know. But anyway, bought another 4 shares of GM, another 3 shares of Southern Company, continuing to get that cost basis down a little bit, quarter after quarter. I do think GM will come back with a vengeance. Yes, I do know that they have already suspended the dividend for Q2, and that's fine with me. I'm going to continue to invest in GM. I think that people will always want to own Tahoes. They'll always want to own Suburbans. They'll always want to own Silverados. And maybe that's just my thoughts, but I think that once they electrify those sort of cars, Cadillacs, the Escalades, I think people will buy them. I don't think that people are going to get away from buying their Tahoes or their Suburbans just because they are electronic vehicles, or electric vehicles, rather. I did follow Kyle from Passive Income Investors suit here, and did pick up 2,500 shares of MindMed. I said, you know what? Some speculation sometimes is good in the portfolio. Looking at the chart, though, if I were to pull it up, it is scary, I will say. So what I might do, some spec in the portfolio is always a little bit good. By far, this is less than 2% of the portfolio, so I have about $1,000 now in MindMed, and then I also have about $1,500 position in Virgin Galactic. So $2,500 out of $400,000 is way less than 1% of the portfolio. So I'm fine with those speculative plays. And so I say that with I guess some oomph to acknowledge that I am not a speculative investor by any means, but I am testing the waters to see what I can do, and I'm fine with trading potentially up to 2 to 3% of the portfolio. I've said 5% in the past, but I don't think I could get $12,000 to $15,000 invested in some of these speculative plays. It could be better for me, but I think just where I am at the moment and what I'm trying to accomplish as a dividend investor, don't think it's necessarily the best thing for me at the moment. Maybe when I get a little bit further along in the career, get a little bit more passive income coming in, I'm able to pay for some of my expenses fully and not have to worry about my expenses anymore. Maybe it's something that I consider a little bit more in the future. But at the moment, covering expenses and making sure that I'm secure in case of any furloughment or job loss is number one for me. And that will take precedence over investing in speculative plays. So might seem a little bit far-fetched because of, I'm younger, I can take sort of those risks now. But at the same time, I do work in a volatile industry. So I am trying to balance out the risks a little bit and also try to remove some of the risks associated with investing in oil and gas, because that has been a very large portion of the portfolio for a very long time. Still huge. And if that does recover from where it was 6 weeks or even 2 months ago, that would by far still be probably the largest part of the portfolio. But it's just been hit so badly over the past 6 weeks to 2 months that that currently is sitting at second compared to financials in the portfolio. I did just shut it. I would have loved to shown you guys the current part of the portfolio where it overviews. So this is just the parts of the portfolio that have been purchasing since the 19th of February. So since kind of this issue that we've kind of been seeing in the market, the volatility we've seen in the market has been kind of a rising. You can see I've invested about $66,000, but not all of that is fresh capital. Some of that is coming from savings that I've kind of put, but some of it is fresh capital. I didn't walk in to this sort of recession with $66,000 on the side. I don't think it was more than 30 grand. So I have been adding a decent amount of capital, staying true to my mantra, continuing to try to add about 50% of the portfolio every single month to some of these, I guess, out of favor positions, and making sure that I am sticking up with my strategy. I maybe have a false self-confidence, or a sense of self-confidence rather, thinking that the strategy is working extremely well. Yes, there have been some cuts, most notably Shell, also Boeing, but I bought into Boeing after they cut the dividend, so I can't use that one as an excuse. GM is another one as well. I'm trying to think if there's any others that I've knowingly owned beforehand and had the dividends cut, and I'm coming to a loss. I can't think of any. But overall, I think that things have gone well. Yes, I did lose about $600 a year in income from Shell, but at the end of the day, I'm still up. I think that was less than like 2% or something like that. So closing in on about $15,000 a year in total dividend income from the entirety of the portfolio. Portfolio sitting at just over 400,000 after this week, and about $15,000 in dividend income. Some of that obviously is stacked away in the 401k, so I can't count that dividend income. But that part that I can, that $15,000, dropped down at one point from about 14.6, 14.7 to 14.2. And now we've clawed ourselves back up to 14.6 with continued investment, consolidating the portfolio and de-risking the portfolio at the same time, consolidating positions. And that's all I really want to talk about. Appreciate it. Like I mentioned, we are down about 1.3% for the week. Not really sure where we are in relation to everything, but I do know we did hit 2,200 at one point in the S&P 500. I believe March 23rd was the date. So down from a max high of about 3,400 on the S&P 500 down to 2,200, and now we're back up to 2862 on the S&P 500. So, we're still halfway through compared to the peaks and troughs of what we're looking at over the past couple of weeks and months in this crazy volatile time. And so, yeah, I think what I'm going to do is I'm going to hop back over to StreamYard and see if you guys have any big questions for me. Don't know how many people are in here at the moment because I've kind of just been rambling on. And yeah, let's just take a quick look. So we got about 33 of you. So this is cool. A little impromptu end of the week stream. So 33 of you guys hopping in. Love it. And so, yeah, let's just walk through some of these quick questions and end it on a high note. I've been going for about 15 minutes now. So hopefully that was helpful for you guys to see where my head is at this week. You can see the beautiful voluminous hair as I have yet to get a haircut during this whole ordeal down here in Trinidad and Tobago. And you can't really see that great view that I got there off the balcony, but one of these days maybe we'll do a stream out there so you guys can take a quick look. Do I sell calls? I've recently started getting into selling some calls. I did sell some AbbVie calls. I think I did a $3 call for June at $92 for AbbVie. And so far so good. Fingers crossed that doesn't work out. That does work out, sorry. I forget what company it was, but I wrote about $200 worth of calls. One was for the 15th, so today. One was for next week. And I bought them back earlier this week to, I guess, get about 60% of those values. So I was like, hey, I can capture 60% of the value, that $200. I think it was like $120. Or I could wait to see if this plays out. And I don't remember if it would have played out or not, but I captured $120 from that. So I'm trying my best. It's something I've learned from Dave, my boy from Hidden Freedom Investing, and some other folks I've been talking to, like Degenerate Dividend, or whatever his name is. Cool guy. Used to be Degenerate Dividend. Now it's Degenerate Gambler. I don't remember what it is, but he's a cool guy. I know he's got some issues with JMac in the past, but had talked to him. He's been doing some calls as well. So just trying to get that strategy up now that I have a couple $100 or a couple hundred shares rather of some of these positions. It's nice to see what I can do to get some extra income, and I'll try to decide if that's something I want to continue with in the future. Negative talk about KMI. Yeah, I don't know. Not 100% sure with what respect you're referring to. I do know they have some debt. They have been relatively well paid in the past. There was that big impact in 2015 when they switched from an MLP to a C Corp, and that obviously took the company's value down by half because that tax savings that you get by being an MLP obviously hits the C Corp aspect of things relatively high. And so anyway, they did take that hit, the dividend cuts as well during that time period, but they have been steadily increasing the dividend from about 12.5 cents back in 2015 when they cut it from 50 cents a share per quarter and they got it back up to $26. So about halfway back up to where they were. I think it's one of the better pipeline companies, to be honest, but I haven't done too much research on all of them. But I am sad to see it go, but at the same time, I don't know if I was just holding on to it because it was one of those nostalgic stocks that I invested in back in 2015. Maybe it was 2014. And so it was one of my first energy investments. So not sure if that was why I was holding on to it. But yeah, that's pretty much all about that one. And VTIQ, I don't know if that's a long or a short play, if it's a bull play, but I keep seeing that one come up. I know VTI is the Vanguard total stock market index, I think, because I know VOO is the S&P. I personally use iShares BlackRock version, so I'm not too sure what the equivalent would be. So maybe let's just see if you can write it down here quick, Dave, what specifically it is, or anybody. VTIQ. Maybe Dave already left the organization. I don't know. Sometimes StreamYard does take a quick moment to actually show up here as well. But just quick before I jump back up there, there are some people. I did see this one sold Disney at 109. I think that's prudent, especially if you don't plan on holding it for the long term. I personally am holding it for the long term. But I think if you did get it at a good price, especially like the 86 range, I think it got all the way down to, and you are swing trading, 109 is not a bad price. I didn't even know it got back up to there. I know it got up to 107, but wow. So any updates on VTIQ? Otherwise, I can take a quick look and see what it is, but I don't want to drop it off. Ask Kyle. He did a video on it. Hi, Kyle. Look it up. Let me take a look. I think it's some sort of bull. VTIQ stock. Well, that doesn't help. Oh, sorry. Not at all, Vanguard. You're right. Thank you. I was getting it convinced with VTI, which is a Vanguard total index. So for some reason, I thought it was like a bull market. VTIQ, yes. I have no thoughts. I honestly haven't done my due diligence. I know JMac has, so I appreciate that brain fart there. JMac has, so if you're interested, he was way ahead of the curve with respect to that. And Kyle did some good analytics on it as well. So yeah, people are starting to correct me now. I just be careful. I think a lot of these folks keep in mind where we are in our investing strategies compared to some of the other folks, right? So just be aware that some of these are spec plays, and you could go to zero, or they could go to, they did introduce it on CNBC as the next $100 billion stock. So not sure if I would believe that 100%. But I think it has just as much likelihood to go to $100 billion as it does to $0. So I would keep that in mind when you're investing in that, and just make sure that you're appropriately measuring your risk tolerance with that. Maybe you have a higher risk tolerance than most, but yeah, just double check and keep up what you're thinking there. So let's see here. DraftKings. So is this like JMac's younger brother? Who is this? Because they're asking about the good stuff that JMac keeps bringing up. But yeah, just quick shout out for some folks. We got Kyle from Passive Income Investor. We got Dave from Hidden Freedom Investing here. Those are my boys. They always are always helping me out and always keeping me in check, making sure I'm doing what I should do. But yes, like you mentioned, VTIQ, you're down $500. I mean, that's just something to be expected. Depending on your volatility and your risk tolerance, could be something where you walk away with that $500 loss. I don't know how much you invested, but, could also go to $100 a share. I honestly don't know. I have not done too much due diligence on it here. What is VFV? Is that the Vanguard Finance? I don't know. VFV stock. Oh, this is the Canadian version of the Vanguard S&P. I mean, in my opinion, if you're going to be investing in the S&P 500, so I don't know 100% about this, but if you're going to be investing in the S&P 500, the thing I would be more concerned about is making sure that you're investing in the S&P 500 in U.S. dollars. And of course, I may be biased because, you know, I'm an American and invest mostly in U.S. stocks. But I mean, if you're investing in U.S. currency companies, why wouldn't you invest them in U.S. dollars to kind of get yourself a little bit of exposure outside of the Canadian aspect of things? So I love the Canadian stocks. I invest in Bank of Nova Scotia. I just talked about that a good bit. But Kyle, maybe you can offer some advice to ETF investor specifically about that. I personally, if I was going to invest in like a Canadian, well, maybe if I was going to invest in Canadian, I would rather invest in U.S. dollars as well. But anyway, there is that currency aspect of things that does kind of trouble me a little bit. So life in Trinidad is good. Currently still down here, have been locked down here for the past 2 months. Haven't left Trinidad since I got back on the 2nd of January. Technically, I have to leave every 30 days, but that's a different story. For not every 30 days, every 3 months. But I think that's waived, obviously, because of the current lockdown situation. So the borders are closed. Don't think they'll be open until July is the current thought. Haven't had restaurants or anything open for the past 6 weeks, 4 weeks, 6 weeks. And 6 weeks, yeah. And they just started opening up earlier this week. So we are currently at 1 case in Trinidad and Tobago, 1 recorded case of the virus. And so fingers crossed that that everything is good and that we don't have any sort of secondary rounds or anything like that. The businesses, I will say, are being cautious. They are distributing hand sanitizer, making sure you wear a mask still when you go in. It's been a great time, man. I love Trinidad. I'm going to end up staying another year at least, unless obviously things that go on with oil and gas companies at the moment go on. And unfortunately, I have to be sent home because it is cheaper for me to be working in Houston than it is to be in this beautiful apartment that the company fortunately pays nicely for me. But at the moment, would love to stay here. It's been a great experience. Love what I'm doing. Love helping add some revenue to the country. Obviously, Trinidad and Tobago oil and gas is a very big component of their economy. So I think 60% of the revenue that the government gets comes from the oil and gas production in the country. So love the fact that I'm here helping out the nation just by helping produce oil and gas. So that's what I love to do, and that's what I will continue to do for the foreseeable future. But yeah, Kyle's out offering some good advice with respect to investing in, say, the S&P 500 in a Canadian currency versus in the U.S. currency. So what he's kind of talking about is investing in VFV, which is the Canadian S&P 500, the U.S. S&P 500 and Canadian dollars versus investing in something like VOO, which is S&P 500 in U.S. dollars. So, yeah, well, this isn't my house, so. But yes, it is nice. Love the place that they really hooked me up with. So AbbVie, I think it's good. Haven't done too much research on it since they announced the Allergan deal, and I thought back then it was undervalued. Now that it's sitting at about $91.70 or $90.70 as of the close today, can't say that I would say if I think that that's overvalued or undervalued. I think at the moment, I can't really say. I like it for the long term, just for the next 2-3 weeks, 2-3 months. Don't necessarily have an opinion on it. I'm going to hold it as long as I can, unless it gets called away from my covered call, because I'm generally not good at writing covered calls. So I need more tips and more experience from Dave, my friend at Hidden Freedom Investing. Let's see here. Abby answered that one. So let's see. Think about Uber. Let's see here. So this is where my investing strategy always does me wrong, and I've kind of been very upfront about this. So my investing strategy has led me not to invest in things like Apple in the past, Amazon in the past, Facebook in the past, and unfortunately for me, that doesn't necessarily mean that it's not a good thing to invest in, right? So we all know what's happening with Facebook now. We all know what's happening with Apple from when I think I first started looking at investing in it back in 2014, 2015 to now. What happened with Amazon when it was back around 800, 900 a couple of years ago. And so I can't say what I think of Uber because it doesn't fit my investing strategy. From an initial standpoint, when you see all the free cash flow that they don't get and the fact the cash outflow that they do have, it makes me weary as somebody that's going to invest in a company, right? I mean, if you just say, wow, okay, every year, 2 years, you have to come back to investors to not just grab $1 billion to keep the program going, but $10 billion. I mean, that's pretty substantial, right? And you're not even showing any sort of free cash flow. You have negative margins on everything. I mean, we're not looking good in that respect. And so that's got me in trouble in the past, though, right? That's why I didn't invest in Tesla. That's why I didn't invest in Uber as well. That's why I didn't invest in Facebook initially. Although Facebook might have been profitable, I just didn't believe it at the $40 price tag. And then I bought it at $72. And then I said, I don't know what I'm doing investing in Facebook. Sold it. This was like 2015, 16, and then bought something else. So I'm historically awful about investing in tech stocks or high growth stocks. So there's that. That's why I'm investing in QQQ because I just need to take the guessing out of it, and I can't do it. Have I heard rumors about Goldman merging with WFC? So I heard a rumor about JP Morgan potentially buying Wells Fargo. Tried looking up as much as I could on the internet. I couldn't see anything, find anything. But I haven't heard about Goldman. So maybe I should check that out and see if that's true. I wouldn't mind it. Goldman's a well-run organization. Wells Fargo doesn't really have a trading arm like like a lot of the other companies. And so I think it could be a good merger. But I guess my question would be, is it a merger or is Wells Fargo trying to take over Goldman Sachs? Anyway, unless Goldman's come up like 10, 15% over the past week since I last looked at it, it's a good buy, man. And if you don't have an investment bank, I think Goldman's a good one. Last time I checked, it was like 150, 160 a share. I don't remember, but I looked at their balance sheet and I looked at everything else and it looked quality. And, if I had unlimited cash, it probably would be something that I invest in. I'm upset I didn't invest in it. What was it, a year and a half, 2 years ago when I dipped to like 130s, 140s back in like 2018. If I remember correctly, maybe it was early 2019 before I left for Trinidad. But great company. So did I buy MindMed? I did. I have 2,500 shares at 42 cents and 42.4 cents. So we'll see. The chart doesn't look very good, but it is a spec play. Like I mentioned, it's like $1,000 position or $1,200 position, something like that. And the portfolio size is around 408,000 as it closed today, not including any cash I have in checking and stuff, which I did just get paid. So, maybe, if you take all that into account, maybe it's closer to 415, 420. But I need to get my per diem. I haven't been asking that. I need to. Thanks for reminding me, guys. So the MindMed, yes, looking at the chart doesn't look very appetizing. So if I do get a couple percent return on that, maybe I will sell it. I don't know. Maybe I'll hold on to it and just say, you know what, this is one for me and my boy Kyle. We'll figure it out. But interesting one. We'll see. WCLD is good for tech. Don't know anything about it, to be 100% transparent with you. I like QQQ because it's NASDAQ 100, so you get about 48, 49% tech, and then you do get some other ones in there as well. So yeah. RTX, I'm going to be 100% transparent. I don't have any comment on it. I do know that Ryan from Independent Investor is heavily into it. He just bought some more, and JMac is heavily into it as well. And I want to say, I think, so I would double check if you were to say use that as an opportunity to buy, but I think PPC Ian also bought, but I'm not 100% sure. So yeah, they're into it. They think it's a good opportunity based off the recent merger that they had and spin-offs as well. So yeah. See, what do I do for a living? I'm a petroleum engineer. So I work with an oil and gas, helping find the best locations to produce oil and gas, development plans of regions, development plans of specific fields. Right now, what I've been doing is doing a lot of development planning for a multitude of different fields that are already developed in the country, off the southeast coast of Trinidad, and later on this year, hopefully, I'll be helping form some of the region strategy or the country strategy, specifically for my company, right? Not the entire country, but my company's region strategy in Trinidad and Tobago to try to make some oil and gas. And that's all I'll leave there because there is an LNG aspect to it as well. My boy Kyle, the pumper for MindMed, I guess we'll call it. TQQQ, I think I've seen that in the past. I think that might be, let me just double check. Is that the bull? TQQQ. Is that the bull? Pro. So I think that's the bull. Yeah, that's the bull. So was it 2x? Yeah, man. That's pretty wild, actually. So TQQQ, let's see if I can get it on there. It was up about 100 or so. Sorry, it's real out of focus there, but up to about 118 at its peak, and it dropped all the way down to 35 because it's a 2x, right? So it's a 2x bull on QQQ. So that would have been interesting to get in at the very bottom because it went from 35 to 75 or whatever it's at now. Would have got you a nice 125, 150%. That would have been cool. So you're buying RTX now, selling at 70s, stop loss at 50s. Cool, man. Yeah, that's the way to play it. I mean, you could also set it up that way with options too, right? And maybe be able to do that. That could be an opportunity. Smart man, I don't know. Maybe I just talk well. Sometimes I say it's my accent because I'm in a foreign country. Sometimes accents help. Sometimes I joke around about it, but yeah. Doesn't show 2x, no? So what is it then? Hot Dave, you got to help me. It's triple leverage. Oh, shit. So how do I feel about Wells Fargo? I think Wells Fargo is fine. Personally, yeah, they might have some troubled assets on the books, but I think that their problems are somewhat behind them. Yes, they're going to have to try to build back some confidence that they've kind of lost with the whole account scandal and fake accounts and all that. And but I think overall they're a good company. They don't have a lot of risks to some really crazy assets and stuff like that that other banks and stuff had in 2008. And I think a lot of those companies don't really do that. There are still mortgage-backed securities, but I think that they're a little bit more verified now. But to be 100% honest, it's riskier than, say, your JP Morgans at the moment. And that's why I started initiating a position in JP Morgan. That's why I sold out of US Bancorp for investing in JP Morgan. And I'm using JP Morgan as kind of a good one. The reason why I'm buying JP Morgan at the moment is because last time I checked, when I was buying, Wells Fargo was trading at like, this is pre-volatility. We're seeing February 2018, 2019 timeframe. I think Wells Fargo was trading anywhere between like 1.2 to 1.6 book value, and JP Morgan was trading at like 2 to 2.5 times book value. I could be getting it wrong. I mean, it could have been 1.8 to 2.2. Regardless, 2 times book value is what's striking out to me. And I was like, well, I'm not going to pay 2 times book value for JP Morgan. It's a great company, but I don't think it's, from a book value standpoint, 33% to 50% more valuable than, say, Wells Fargo. And now what you're looking at is like Wells Fargo trading at like half book value, so 0.5 book value, and JP Morgan being like, I think 1 to 90%, 100 to 90% book value. And keep in mind, I mean, just because a company's trading at book value now, right, doesn't mean that it can't go away. And that just because it's trading at 50% book value doesn't mean 50% of the assets have to go away, right? So what it means is, like, let's just take, for example, the assets that Wells Fargo has on the books. Let's just say it's $2 trillion of assets, and they have $1.9 trillion of liabilities. So the shareholder equity is $100 billion, right? All that means is what? What is that? 5%, or what is that? 2.5% of the assets have to go down. So 2.5% of those companies have to either default on their loans or just be completely trash assets for that to go down to 1.95 trillion. Keep in mind, the liabilities aren't going to change, right? They still owe $1.9 trillion. So immediately you just wiped out $50 billion worth of assets, and immediately that, 1.0 book value goes down to 0.5, but in actuality now is a 100% book value, because 50% of those assets, or sorry, not 50%, 5% of those assets, or 2.5% of those assets are destroyed, right? So keep in mind, Wells Fargo still has that 1.9 trillion. You went from $2 trillion of assets down to $1.95 trillion in assets, because those 50 billion in assets are now worthless. So it doesn't take a lot to skew the book value of, say, a Wells Fargo or a JP Morgan. It just takes 2%, 3%, 4%. And that's what happened in 2008, right? I mean, you had, 8% credit losses or 8% defaults. And I mean, not only was it 8% defaults, but on mortgages, but then they were leveraging off of that, right? So that 8% could have turned into 40%, 50%, sometimes 20 times 8%, right? So that's what ends up happening. And then it's not just, let's say, $8 billion loss, but it's the $8 billion loss on the bad loans, plus whatever trades that you made on top of that. So it can leverage really quick. And I'm not really that well versed on it, but yeah, I think that it warrants the fact that, yes, there could be more problems in Wells Fargo's assets that could cause the issues that you're kind of seeing. And it won't take much of an asset loss or asset drop or some of those assets to be written down to make that 50% book value immediately go to 100% book value, because a small portion of those loans get written off. Let's see here. Favorite stock. So I don't want to go more than an hour, so we're about 45 minutes in. So hopefully you guys can ask your last final questions, and then we can help out. But really appreciate this impromptu stream and you guys hopping on. It's been great. Let's think. I'm a sucker for BHP, man. BBL is a good one. At the moment, I really like JP Morgan. I've been buying a lot of that. What else have I been buying a lot of? I've also been buying a lot of I've been buying QQQ, but you guys know that just because I'm trying to get my tech exposure up. But buying Boeing, but that's because I think long term it's going to be okay. Realty Income, man, is up there. I was real out of favor with Realty Income for quite some time, and that was because it jumped like huge, right? I mean, it went to the point where dividend yield was 3-ish%, 3.5%. I'm like, that doesn't make any sense. The growth isn't there. It didn't make any sense. I mean, it was like $85. I was like, it's not worth $85. But down to the $45, $50 range, man, it's a good buy. And some folks are real concerned about what about retail being closed and whatnot. Realty Income did a really good earnings report call and mentioned everything, being very transparent about the companies that are actually having trouble paying the rent. And it's mostly just been fitness companies, theaters, and restaurants, of which I think it was like less than 2.5% of their portfolio. And was really pleased because they say like 18% retail. And of course you're like, retail, shit. I mean, 18%, it's almost a quarter of the rent, you know what I mean? And they have to pay interest on some of these loans, you know what I mean? Like they're making like, a couple percent, at the end of the day, that they then distribute 90% of that because they're a REIT to shareholders. So you're like, they lose 20% of the income. It's going to look pretty stretched, right? But keep in mind, they keep retail as pharmacies and grocery stores, Home Depots, stuff like that. And those did well. A lot of them stayed open in the U.S. So, but another good one that I would like, because a lot of people mentioning Realty Income Corp. If you want a little bit more international exposure, maybe some European exposure, I really like WP Carey. And I actually hold that one in my Roth. And that's a good price too right now. And I think that one might actually be better to look at. It's trading, I think it was like 10 to 12x funds from operations. And I don't think the funds from operations are going to hit that bad. I think they're in a similar spot to Realty Income Corp. They might lose like 2.5-3% of rents. For now, of course, this is the beginning of a recession, so things can change for sure. Occupancy can dry up, people move, stuff like that. But for right now, I think for the long term, if you're going to pick up anything, that's at a discount too. That was trading in the 70s not too long ago, maybe even the 80s, I think. It might actually touch 90 too. Do I have it on here? I don't have this on here really quick. I was going to say I could do a quick look, but that one warrants your interest. It's about 33% European, so some Germany, some Spain, and some UK. I like that one a lot. And they're very similar. They pay quarterly though, so if you're into that monthly dividend, Realty Income might be your stock of choice, but it is what it is. Good time to get into financials. I agree. Am I involved in BA? Yeah, I just mentioned have about 40, 45 shares now of Boeing. I'm not balling out, buying 100 share blocks like Ryan from Independent Investor, which is a great gift, by the way. I think $122, $1,200 position in Boeing. I mean, what a gift, man. And I think they'll be paying the dividend back, pretty soon. Not next quarter or anything like that, but as they kind of get everything, the thing that does bother me about Boeing is the $25 billion in debt offering. I was just doing some quick math. They were saying it was either like high 4s to low 5%, or it was high 5 to low 6% interest rate. But so I think I calculated like either 1.1 or 1.25 billion or something like that they now have obligated in interest payments annually based off of that $25 billion debt offering. And I was like, that's going to hit cash flow, man. That's going to hit free cash. And fingers crossed that they don't need that 25 billion. And at the end, they were just doing it for worst case scenario and based off their estimates. And, maybe we don't get to that point. And so they can get back 10, 15 billion of it. But I do know that they needed some immediate liquidity and they got it, $25 billion worth. So fingers crossed they don't need to use all of it. But if they did end up using all that 25 billion, that's $1 billion a year in interest that now that company is obligated to pay. And that doesn't change. It's not variable. That was fixed like forget, it was like anywhere between high 4s to low 6%. And I don't remember if it stopped at low 5%, or if that was a 5.5, high 5.5 to 6.5%. So anyway, own zero bank stocks. Am I smart to avoid real estate right now? Physical real estate investment trust. What's your time horizon? All real dependent, man. I don't know. The thing that is positive with real estate right now, and I have been thinking about this quite a bit, and I don't know the answer, but this is just kind of my thinking. And maybe Dave or somebody in the comment section that's a little bit more familiar with real estate and knows can help me out. But if you buy real estate now, and we are offering, say, another $2 to $3 trillion of banknotes out to people, whether it's businesses, whether it's citizens. And I want to say something else. It's kind of funny, right? Because they offered $2 to $3 trillion, right, to this Corona stimulus package. I haven't seen a dollar of that, right? So it's kind of funny. Like, you do see like some people getting these checks and whatnot, but like some of us haven't seen a dollar of it. And it's like, that's $2 to $3 trillion, right? I mean, that's like Apple, Amazon, and Google combined. And you know, there's 330 million Americans. I haven't seen a dollar of it, you know? So it's crazy to think, and I'm not going to see a dollar of any of the new stuff that they do either, right? And it's kind of disheartening, you know what I mean? It's just like, well, where is this money going? Or is the government actually using it appropriately, right? Like, of the 330 million Americans that are there in the U.S., or 350, whatever it is now, it's like, anyway, that's just my thoughts. It's like, is it going the right spot? But anyway, my thought is say we do get to the point where we do get some inflation, because we will, based off the fact that we're kind of inflating our GDP by 10, 20, 30%, or not deflating it, but increasing our debt rather by 10, 20, 30%, rather quickly, you know, almost overnight, compared to what it's usually like. In that respect, if you were to buy something now at current kind of dollar value, when the inflation does kind of settle in the months to come, you know, the dollar is worth less. That would then increase the amount of dollars people need. So, you know, you might have needed $1,000 on your mortgage to kind of break even, but with inflation, you know, now the value of the dollar has kind of gone down. So that's not going to change your mortgage note of $1,000 a month to kind of break even. And with inflation, you're going to need, let's just say, the next year, $1,050 in rent, you know, just to keep up with inflation. Next year, maybe $1,100 in rent just to keep up with inflation. Now you have that inflation sort of built into your rent payments, right? Because, you know, you go up with cost of living. You know, cost of living goes up 2 to 3% a year. Inflation-ish kind of goes up 2 to 3% a year. Now, if you're kind of in this inflationary time frame, you have that loan at, say, $1,000. That's where you purchase the house at. But now the house value is now kind of accelerated, right? I mean, just to have the same net present value, it needs to increase by, say, 20, 30% overnight. And so does that mean your rent payments go up 20, 30%? Not overnight, of course, but, you know, accelerate. You know, they used to go up 2 to 3% a year. Now are they going up, you know, 5 to 8% a year based off of inflation? I don't know. But your debt payment doesn't change. And so I don't know if that's going to help real estate investment trusts in the future, because the rents that they're going to have to pay are going to go up, and but their tenants are going to have to pay are going to go up, but they bought those buildings and warehouses and everything at, let's say, $100 million, and the rent's got to go up. You know what I mean? So, but I think in some of those contracts are already written, right? It goes up 2 to 3% regardless. And so real estate investment trusts would either have to break those loans and restart, or buy new properties in order for that to work. So would love anybody's thoughts. It's an incomplete thought. I don't have the answer, but it's something to ponder. And same thing with investing in stocks, right? I mean, you buy today, but, you know, you're kind of buying it at today's dollars. And companies' market cap is only going to go up if inflation goes up. So you're buying it at, say, today's dollars. It kind of helps with inflation, fingers crossed, if they're able to keep up their revenues and kind of distribute some of that inflation cost to their customers. But anyway, that's just my thoughts. Don't know anything about negative interest rates. Not that intelligent about it. So I apologize there. Let's just see. Just had a huge wave of comments kind of come in here. Federal Realty or Realty Income. I don't know anything about Federal Realty, so I apologize. I like Realty Income though. Yeah, I would agree. I like Boeing a lot for sure. Boeing from 100 to 180. I think that's good. Not sure if you should re-enter. Their dividends lost and all the troubles. Hey, man, it's all dependent on your strategy, right? I mean, if you want to buy and hold for the long term, you think the dividend's going to come back, think about it. But yeah, I love 3M. A lot of the products that I use in the office is 3M. A lot of the products that I use in the field is 3M. The masks are 3M. Any sort of like reflective tape, 3M. Our car vinyls are 3M. And so it really depends, right? One thing that I would check out, because I have been thinking about this a lot, is I'm a big 3M guy just because I think that it's kind of overdone. The sell-off from the 220 a share in mid 2019, or maybe it was late 2018, to like the 140, 150 range. I was like, that's overdone, man. And I think that is it was warranted. I think it was overpriced at 210, 220. Don't get me wrong, but anyway, going back to it, I don't know how much they make from, let's say, their Post-it notes. I don't know how much they make from, let's say, their easel boards, their markers, office supplies that they kind of supply. So I don't know what sort of revenue is coming from that. And with now a lot of people probably transitioning to working from home, this is something I've thought about, not even during this last 2-month time period, but since I started working kind of in this newer environment where people are starting to move home, and the company that I work for is starting to talk working from home. And now obviously we're doing it because we need to, but back then it was kind of like a privilege and a test to see, because a lot of people are heading that way. And I was like, there's a lot of equipment, Post-it notes, and all this junk that we use to collaborate. Are they going to be used in this work from home environment? I don't know the answer to that. Yes, people use Post-it notes at home, but I think they use Post-it notes a lot more in the office. So that was my thought. Is like, I don't know any sort of, let's say, increase in masks. Let's say if like mask usage kind of gets more typical in, let's say, Western society as it is in like Eastern societies, if somebody's sick or something like that. If that becomes sort of a thing now for at least a couple of years, that increase would potentially be offset by that decrease in office supply revenue from Post-it notes and whatnot that they were expecting before. But I think overall at 3M, man, they make too many products to count. Thousands of products, stuff that you wouldn't even think of. I was like, we're doing a project, like I'm, trying to design a well, get a well project kind of designed and signed through the other day. And well, not the other day, but like 6 months ago when I first started working here. And I'm like, who makes X component? And they're like 3M. And I'm like, okay, I'm a shareholder. I'm happy about it. So the simplest things that you're like, there's no way. And then 3M, just like their name slapped on it, shows up everywhere. So somebody did ask about Colgate. I don't have an opinion. I don't know. I do see that people do enjoy it. To be 100% honest, Colgate, I think is one of the only toothpastes I see down here in Trinidad. So it's an international company for sure. So if that's something that interests you, yeah. Cut payroll tax, have the rest of the people, cool. I don't have an answer for you. Partially filled limit orders. Yeah, I don't know. Uncle Dave always coming in with the wiseness. Let's see. House values at all-time highs with interest close to zero. Maybe take out a fixed mortgage now, purchase 5 to 10 years. Yeah, I don't know. That's too much speculation for me. So yeah, governor just extended foreclosure June 2nd now in Florida. Wow. Dave, sorry to hear that, man. I know you and I talked about that a good bit. That sucks. Hopefully that gets resolved, man. Thoughts on MO? The yield at 10% looks high. So I listened to the earnings call of both Altria Group and Philip Morris because I'm a shareholder of both. And they both obviously are Marlboro brand cigarettes, Juul, 10% ownership in Anheuser-Busch, owners of a lot of smokeless tobaccos, smoking tobaccos, regardless. I'm a holder, man, and I'm not going to stop being a holder. I looked at the cash flow statement. I don't see any problem with it. I wouldn't be surprised if they take the opportunity to trim the dividend, and I don't think a lot of companies would. I think some companies and a lot of companies might be prudent to evaluate their dividend and see what their ambitions are, like Shell. I'm not upset Shell cut the dividend. From a dividend investor standpoint, I am. From a long-term investor and knowing where they're going, because I'm in the industry, I think it's prudent. And I wouldn't mind seeing other companies do the same to kind of reset their kind of basis. As a dividend investor, I can understand where you're immediately being like, what? But sometimes some of these companies, like take Shell for example, in 2019 they paid $15 billion in dividends. They can now take 10 billion of those dividends that they were paying out because they cut the dividend and invest them in either greener energies, higher return projects. If they invested in something over the next 2 to 3 years, that $10 billion into something that yields a $2 billion, a 20% return, that's $2 billion that you're going to see start hitting the cash flow statement in a matter of a couple of years. So $10 billion worth of projects, that's going to take a couple of years to play out, right? But that capital employed, if they're able to get a 20% return on it, which not all of them do, they kind of average anywhere between 6 to 15% in this current environment at about $30 to $50 a barrel. So, it kind of varies. They're not going to get that 20% return, but sometimes you do find them. And Shell's good at it. I've worked with them in the past, and they know what they're doing. They're good operators. I trust them, and that's why I trust them with my investment. And so when they cut the dividend, I'm like, okay, that's fine. I know what they're doing. I'm just curious if they're doing 100% to pay down debt and kind of get their what's the word I'm looking at? Gearing ratio. So the amount of debt and cash that they have to kind of leverage themselves in check, or if they're using it to accelerate green investments. So I think Disney was also prudent. Disney could have paid the dividend, but did they need to? And is it better to have, well, they didn't cut the dividend. Shell cut the dividend. Disney suspended the dividend. So keep in mind, Disney is still on hold to potentially pay that $1.6 billion in dividends in January of next year. So yeah, I would just be cautious. Understand why the company is cutting the dividend. Are they cutting the dividend to be prudent? Or are they cutting the dividend because they honestly can't afford it? And in the case of, say, Shell, they could have afforded it. And, I'm fine with them realigning how the company is run in the future because, and I think in the future, how do I say this? Oil and gas companies, the margins have been being squeezed for a long time. And this is coming from somebody that's in the oil and gas industry. Not to say that it's golden, not to say it's my company's views, but it's my views of what's going on. And so oil and gas companies need to change the way that they operate in order to compete with new energies. it's too early at the moment to go full green energy, and it's too late to stay 100% fossil fuels. So they kind of have to play in this gate where efficiencies are still happening in the wind and solar markets, whether they're getting more efficient with the cost that it costs, the cost per milliwatt hour that they're getting per specific cost per watt rather out of each individual, say, solar cell, or that the efficiency of each solar cell is getting better. And it's happening on both ends, right? Costs are coming down per watt per cell, and the efficiency is going up from 12 to 15 to 16%. So that is a 33% increase over a couple of years. And so that's a huge improvement. So even if cost per watt stays the same, it's a 500 watt sort of, let's say, panel, the efficiency goes up by, say, 33%. It's going to look pretty good, right? So anyway, yeah, I think it's an interesting time. And so you can't be this dividend powerhouse that you used to be in the past when you're trying to balance old investment strategies and new investment strategies, reinvent the organization, become something that's more efficient, and have 40 to 50% of your, maybe not that much, but 30 to 40% of your cash flow immediately going to dividends when you're trying to balance and juggle these two. You need more flexibility, So eliminate $10 billion out of the obligation to shareholders and use that 20% increase in cash flow that you no longer have to pay to shareholders and use it as flexibility, pay down debt, get ahead on your green energy investments. They might not be the best, but they might go more efficient over time, and you can kind of fix them up, and it'd be more like operating expenditures and capital expenditures. So it's a tough time in the oil industry right now. Margins continue to get squeezed. You have mom and pops that are like getting debt out of the wazoo. So investing in some of these like small independents is a horrible idea because they're just like, how much can the bank give me? And the bank's like, take all of our money. We need to invest it somewhere. So yeah. Interesting times in oil and gas. That's my opinion. It's not perfect. And then you also have the aspect that they're trying to meet targets, right? The low efficiency or the low carbon targets as well. So, sorry, just going back on some of these comments, and I am going to cut it off here soon because I didn't expect to go for that long. Yeah. So at 3M's got 55,000 products. So that's pretty wild. People catching up on the MO discussion. So yeah, I'm not going to talk about my favorite oil company. I mean, favorite oil companies I like to work with. I'm not going to do that. I have three majors that I have in my portfolio: BP, Shell, Exxon, and that's all I'll say. I used to have Phillips 66, sold that. Kinder Morgan sold that. I have Cheniere Energy Partners, LNG. I think it's still a good company. They do have a lot of debt, though. That is concerning. I do have some small independents that are high risk, high reward. Yeah. Don't know anything about PBA. Can Berkshire ever beat S&P 500 returns in the future? So you have to think. Berkshire, however you want to pronounce it, is an interesting one, right? It's about 40 different companies, overarching companies that produce massive amounts of cash flow, and to the point where over the past couple of years they've gained like $130 billion worth of cash that's kind of just sitting on the sidelines. So think about what I was talking about a little bit earlier. How easy is it going to be to find one single project that will invest, let's say, $100 billion and get a 20% return immediately year after year. So something that you can invest $100 billion and get $20 billion in return forever. And that's difficult. That's real difficult. But then think about $128 billion and how many small companies you can underwrite and invest in. You're talking, let's say you want to buy like some real small companies that are going to grow 10, 20, as quick as Berkshire did. Let's say 20% annual growth a year. That's going to be companies that are 1 to 2 billion, maybe up to $10 billion. So at a minimum, you're going to have to underwrite 10 deals. I mean, that's difficult. And that takes time. And that takes, by the time you're done underwriting the first one, you're going to have another $10 billion sitting right there because the company is so efficient at making cash. And so it's difficult, man. Are they going to ever beat the S&P 500? I don't know. I think when you have so much cash that's sitting there, not being redeployed, you're losing efficiency, right? You're losing capital efficiency, right? You're not having that capital employed. And so when you don't have capital employed, it's just sitting on the books. It's going to show you like a very low return, right? And so it's difficult. I can understand where he's coming from. Because if I had, let's say, like $20 million, like what all I want to do is invest in the stock market and get an S&P 500 return, or would I want to try to find something that's going to get me more of a return so I can make like bigger deals and grow bigger and try to be more efficient at helping people, which is why I do a lot of this stuff, right? I'm on stream to help you guys to talk and maybe give you some advice as to what I think potentially might be worthwhile, right? So I don't have an answer, but yes, I love the collabs with Kyle as well. So if you guys haven't already, Kyle, somehow if you could like somehow get them to subscribe to our channel, the Passive Income Educators channel. Actually, let's see if I can do it. Sorry, give me a quick second. Passive Income Educator YouTube. And I'll drop the link here. If you guys could just quickly go over and subscribe. I don't know if that's going to work or not, but if you could, click on it. Let me know if it works. We'll see. And hopefully my stream didn't just crash. It might have. It might have crashed. We're good. Okay. You think they'll ever pay a dividend? Oh, you mean Berkshire? I don't know. This is a question for Kyle. He knows a lot more about it than I do. I looked at it the other day, and I agree with Kyle. I don't know how, with the cash flow that they're getting, how they could ever cut that dividend. Yeah, I don't see how they could cut it, to be honest with you. I mean, they're making so much cash. And make sure when you're looking at real estate investment trusts, you're looking at the funds from operations. You're not looking at the earnings. Earnings, depreciation is mixed in there, and tax one-offs and stuff like that. They're not giving you the earnings, right? They're giving you the cash flow. So they're giving 90% of the cash flow out to you guys. So they're making like, I forget what it was, like $2.25 or $2.35 it was, if I remember correctly. Company was worth like $10.60 yesterday. So from like a price to funds from operations, you're looking at like $4 to $5, or sorry, $4 to $5. Yeah, $4 to $5 of, sorry, am I right? No, just 4 to 5 times price to funds from operations, which is cheap, right? I mean, you'd be ecstatic to get 10 to 15 times, and you're getting, half that. So, and then they were paying out $1.89, $1.90 in funds from operations, but they're like obligated to get like $200 or $2.25 or $2 every single year from the government in terms of funds from operations. So, I mean, doesn't make sense why it's so cheap. Maybe it's political. Kyle talks about it a good bit. Maybe they're making numbers up also. That's a potential as well, and that helps out as well. Opinion on Bitcoin. I don't have one. My opinion is that it's interesting. I believe in it long term. I don't think that it is currently mainstream enough for me to want to invest in it. At the moment, it's kind of reserved for people speculating, and until it becomes something that's more routinely able to be purchased and used in day-to-day life, I will be more for it. The volatility is too much at the moment. It's too speculative. Can be manipulated too much at the moment from a price perspective, not from a, like, you can get scammed out of Bitcoin and stuff like that. You can get scammed, obviously, but that's probably due to more to your stupidity. So I think it's very secure. Bitcoin is very secure, but the volatility aspect of things is bothersome. And so it was looking much viable in 2018 timeframe, and then it dropped 50% in value, even more so, 75% in value at its worst point. And I don't think companies will deal in a currency that can drop 75% within 2 to 3 months, because that's just, you need stability. And until it can get something that's more like the US dollar, the Aussie dollar, the Canadian dollar, the euro, that has more trust and more long-term scoping in it, less volatility, I think it's going to be impossible. Does the portfolio ever cause me stress? No. But I do spend a lot of time on it, looking at it, talking about it with you guys a good bit. Sometimes I think that I spend too much time talking to you guys about it with little return, unfortunately. So that the part that does cause me stress isn't the portfolio management aspect of things. It's making sure that I'm providing you guys with the content. A lot of stress that I have is from the whole thing, is arguing mentally with the YouTube algorithm and fighting to stay in the YouTube algorithm, and not so much with the portfolio management aspect of things. I want to make sure that I'm getting the content out to as many people as I can to help them, because I think a lot of people, I still see it, and I just started doing Twitter the other day. So if you guys are interested in following me at Twitter, feel free. Would love to talk to you guys on it. I just noticed, like, the people immediately going for high yield companies, no idea as to if the cash flow is going to even support it, all that stuff. And it's like almost entering a new world. I feel like we're making headway, between all of us YouTube collaborators that, are on this channel, whether it's like Ryan Scribner's of the world, PPC Ian's, Ryan from Independent Investor, Kyle, Dave, J-Mac, all those guys that are really like hammering it away every week. I feel like we're making headway and people are really starting to learn. There are some folks that come in that are just starting, and I can understand that. But I entered Twitter, and it's like, I don't know if it's just the people that I started following, that like some of the stuff that they say, some of the companies that they recommend. And I'm like, whoa, like, you're talking about dividends, long-term investing, and like those are the companies you're bringing up. And so dealing with that sort of stuff, making sure that I try to help people and try to make sure that I'm helping people, make their decision, right? Because dividend investing might not be their decision. Dividend investing might not be for them, but at least helping from my perspective as a dividend investor, show them that there are other perspectives and how you can use my perspective to see what works for you is what my message is. I'm trying to help out with. You could be a swing trader. You could be a day trader. I don't have any problem with that. If it works for you, you got the time to do the research and stuff like that. So, but yeah, the YouTube aspect of things is the most stressful part. And Kyle, I'm sure, can attest to that a little bit more. So yeah, I'm gonna try to probably cut it down. Probably I'll give it till 6 o'clock p.m. Eastern time if you guys are interested. Still want to grab something to eat. They're gonna close down everything by 8 o'clock. So unfortunately, we still have curfew and stuff like that here in Trinidad. So if you guys have any more questions, I'll wait out till 6 o'clock. But if we ended early, we ended early. Let's see how many people we still have on here. So we have about 47. So that's pretty good. I generally don't pull that many people, especially on an impromptu stream. So appreciate that. Really love that. Make sure if you haven't already subscribed to the channel, it means a lot to me. I'm close to 6K. So really appreciate you guys always helping me out with that. Didn't think I'd ever make it to 6K. I remember talking to my brother when I first started out, and I was like, dude, I got like 25 subscribers. And he was like, click all my ads and stuff. I'm like, they're going to ban me, man. And then, of course, they changed the rules to 1,000 subscribers. But he was always a big pusher for me to continue to do more live streams. And that's probably what inspired me to do this one here. So off the cuff, rather than having like a formal sit down stream. Yeah, sunlight in the background is awesome. Actually, maybe I'll show you guys the sunset quickly before I sign off. But yeah, that's probably what I'll do. Mostly people chatting at the moment, not really asking questions. So appreciate it. If you guys are interested in asking me any questions, ask me on my Twitter at RealMapMoney. Follow me on Instagram as well. Follow us at Passive Income Educator YouTube. I'll put that back in the description here as well. And I'll show you guys real quick the view. Let's see if I can flip this bad boy around. Appreciate that we're going mobile. Let's hide this here. And let's see if we can get you guys a decent view. So here's the off the balcony for you guys. And hopefully I don't lose you guys on the internet. So let me open there's my ashtray. There's the view. Got some clouds coming in. Venezuela's out that way. So if you were to go forever, Venezuela's out towards that way. And here's the west. And here's the view. Pretty mountainous. So love it here for sure. It's definitely a good time. Let's flip this camera around and finish up the stream. But hopefully that was a cool view for you guys. I've tried putting it on before in the past. And for some reason, sometimes it just doesn't work out that well. So yes, if you guys ever want to come down and visit here in Trinidad, message me. More than happy to host you guys. I got extra bedrooms for you guys if you're interested. And love it down here. If I'm still here when you retire, hopefully it's like next year, Dave, because I'm probably going to be leaving here potentially sooner rather than later. You never know with the oil and gas prices the way they are. Although they did kind of get back up to $30 from a West Texas Intermediate standpoint. So, but down here in Trinidad, I'm more so worried about the natural gas prices. Below $2 a barrel, not looking good. But I do work for potentially, I will say, international oil and gas company. So just because the region is focused on gas doesn't necessarily mean that I'm, I guess, shielded from poor oil prices, because obviously it's an international oil and gas company. So, but yeah, really hope you guys enjoyed this. Hope you liked the view, and would love you guys to continue to subscribe. Hopefully I'll continue to do more spontaneous live streams like this. And yeah, I'll see you guys on the next one, man. Really appreciated it. And I would love you guys, to ask me any sort of comments and the questions. Message me on Twitter, message me on Instagram. I'm available. If you haven't already, also check us out on Facebook. Also, if you guys are interested, we do have a WhatsApp group that we talk to all the time. And I'll leave the number down here in the description, but I'll also say, not description, the board here, whatever the heck this is called, comment section. Message that on WhatsApp. See if you want to, if you want to join our WhatsApp group, it's free, no charge or anything like that. Just want to make sure that we get a great continued group. We got about 10 to 15 people that contribute relatively regularly. Then we got some stranglers that kind of just sit in the background, chime in once every couple days or so. But really want to grow this up to the 250, potentially more people that we can for free. You know what I mean? Message me on WhatsApp. I'm not going to answer regular messages. That costs me extra. And I'm trying to save every penny so I can keep investing. You know what I mean? So appreciate it, man. I'm going to do myself a favor, grab something quick to eat, and then probably have myself a cigar. It's been a couple weeks, and I'll show you guys that as well. I got some good ones. Some folks have been following me all the way back since my my cigar days, and I picked these up back in the October time frame, and these are the good ones. You know what I mean? These are the guys that you see, you know, Grant Cardone smoking a lot, El Cubanos, you know. So anyway, guys, appreciate it. I'll talk to you guys soon, all right? And like I said, reach out to us any way you can, and look forward to talking to you. You know, I'm sure Dave will be there. I'm sure Kyle will be there. We're all going to be there. So cheers, guys. I'll see you soon.